to our Emerson Group monthly call for July 2023. My name is Nick Emerson, owner and operator of the Emerson Group, Real Estate Professionals, where we specialize in representing real estate investors utilizing the 1031 exchange to create, build, and pass on generational wealth. Today's call, we're going to be talking about a structured installment sale, another tax-deferred strategy for clients to consider. However, in this case, this is something you can evaluate for your primary residence, whereas many other tax deferral strategies were pressed upon the investment side of things. So excited to talk more about what a structured installment sale is, what the difference between a traditional versus structured, more about a case study on kind of what do the financials look like for a structured installment sale on paper, and really get a well-rounded idea of what it is and what the benefits are. So to make sure that we really understand all the nuances of a structured installment sale, we're joined by John Dudek with Sage Settlement Consulting. John, thanks for your commitment of time today and for joining us.
Yeah, absolutely. Thanks, Nick. Very happy to be talking with you and your listeners about structured installment sales. You can see from my bio, I've spent most of my career in the insurance industry, been in a lot of different spots, helping small businesses with group benefits and commercial insurance, also helping individuals with buy-sell life insurance, key man life insurance, helping people with annuities. And now my career has taken me into talking to wonderful people like you in the real estate world to show them some new strategies they may not have seen before.
So safe to say you really like insurance with all this background.
Absolutely. As a kid, I just dreamed of being an insurance agent. So I'm realizing my dream.
We appreciate you realizing it for us. All right, cool. So John, what is a structured installment sale at its kind of macro?
Yeah, so what an installment sale essentially is selling an asset and taking a payment, at least one payment for that asset a year after the sale was made. So that's what an installment sale is. And then you can see there's a couple IRS codes, 453 and 537, that you can look up and read if you ever get a little sleepy at night and you want to know more about the installment method of accounting. But that's kind of where the structured installment sale stems from. Okay,
so really an installment sale could be any schedule of payments, provided one is outside of 1 year. Is that like, we could say, hey, I'll buy your property and I'll make a lump sum payment after year one. Is that an installment sale?
Yeah, it's as long as one of the payments is received after the tax year the sale is made.
Okay. Well, that's pretty straightforward. Now let's kind of dig into more of the nuances or details about the structured installment sale.
Yeah, absolutely. So, the traditional installment sale, been around for a while. Some of your listeners may have heard of it before. The way it would work is you're selling a home or investment property, and the buyer says, I'm going to make a down payment to you this year, and then I'm going to make some scheduled payments over the course of the next 5 years, 10 years, 20 years, whatever it is. So that has been an option for sellers in the past. Kind of where the structured installment sale differs is it eliminates a little bit of the risk because from a seller's standpoint, it sounds great to take some payments over time from the buyer, but now you're relying on the creditworthiness of that buyer. You're making an agreement with them that spans over the course of, say, 10 years. You got to make sure that he's able to make those payments over those 10 years. And so are you vetting that buyer? How do you know whether or not they can do that? So where the structured installment sale comes in, I think the next slide probably shows that the best. Structured installment sale introduces a third party, a life insurance carrier, where now the buyer makes their payments and the life insurance company steps in to make payments to the seller, which eliminates the risk because now you're relying on the creditworthiness of a highly rated, highly regulated life insurance company instead of a buyer.
Right. So you're going from dealing with Joe Smith, who's got a net worth of $100,000 versus the market cap of insurance companies that have billions of dollars. Slightly more creditworthy.
There you go. Yeah, it should help you sleep a little bit better at night, knowing that that's what you're backed by.
So at the top here, we had, right, the top step one, buyer and seller execute sale with agreed payments, right? Then you went over buyer signs payments and pays premium to assignment company, which we wanted to clarify. Assignment company and insurance company can be viewed as one entity. Is that correct, John?
Yeah. When you're dealing with a life insurance company, they all have their own assignment companies in-house. So we're giving you the kind of the technical terms here. But when you think of it structured installment sale, it's really a three-party transaction. You've got the buyer, the seller, and the life insurance company assignment company are mixed together. But like you said, you start with the buyer and the seller making an agreement. Hey, I'm going to buy your house. I'm going to make payments over X amount of years. At that point, where the structured installment sale differs is now the buyer takes the full purchase price and pays it to the assignment company / life insurance company. And they say, here's the full purchase price. Now this is, we're assigning those payments that need to be made from me, the buyer, to you, the life insurance company.
Perfect. So then we're on, step two, buyer assigns. Then we're down to step three, assignment company purchases annuity from life company.
Yeah. So again, that's all kind of done between the life insurance company and the assignment company, but an annuity is purchased at that time with the money from the buyer. So an annuity is purchased. The life insurance company will issue that annuity back to this assignment company. So the owner of the annuity is the assignment company because it's on them. They're assigned to make the payments so that they own that annuity. And then finally, the life company makes the payments to the seller through that annuity.
And then we'll go take a step back here too, so we can just clarify the traditional versus the structured, right? It's just, again, making sure it's the difference between, a John Smith versus an insurance company, and then just acknowledging that the risk and the liability of, hey, you might sell this property on installment sale to John Smith, but you might end up getting that property back in the form of a default. And I think most people that are doing this probably don't want to be getting their properties back. They want to be moving towards simplicity and receiving guaranteed premiums and payments every year.
Exactly. Yeah. And a lot of these installment sales, they have interest built in. So again, you're relying on Joe Schmo down the street to pay you the right interest payment. So it gets a little bit risky. So when you transfer that to the life insurance company that, like you said, has billions in assets, it's a little bit more safe.
Yeah. So we don't need to worry about calling insurance company to let them know their payment was off by 10 cents, right? We want to worry about that type of stuff. Okay. Perfect.
Exactly.
All right, cool. So when are structured installment sales typically the most beneficial?
Right. Yeah. So there's a number of situations that really make sense for a structured installment sale. First and foremost, alternative to a 1031 exchange or a DST. I know you're very familiar with these transactions, but they're also capital gains plays essentially. But in those transactions, you're flipping one property into another or into the DST. This is more of a cashing out strategy. I've got a property. I want to liquidate it. I want to spread it out over time, earn interest on it, and also defer and lower my capital gains. And you can do it on a primary residence where you can't, as you said at the beginning, you can't do that for some of these other exchanges.
Yeah, I think that's one of the awesome things about this conversation, John, is that we're filling a space where oftentimes we have solutions for investors, right, to how to mitigate or defer taxes. Yet we don't really have a lot of conversations or solutions for people that might be selling a property that's got, a gain in excess of $1 million, right? That's still a large tax event. And so this is awesome to be able to understand a solution to that problem for people that have primary or second homes. So to that point, right, diversification and liquidating a second home. So just changing your positions, having different positions. So with diversification, right, if you already have plenty of assets invested as rentals, you don't want to be in the real estate game. That could be another piece to the menu, right? Or piece to your portfolio, where you could choose to convert it to simplified position and a guaranteed payment stream. So
there you go. Yeah. Yeah. You got 4 or 5 rental properties. You want to liquidate one of them and, like you said, turn it into cash and kind of lose one headache. This is a great solution for that.
perfect. And then I think fixed income, of course, we talked about that in retirement. It's a guaranteed payment every month, right? You have a schedule with a paper that says, here's what you're going to get. So there's no surprises.
And we'll get into the kind of the nuts and bolts of how the annuities work, but with certain options, you can get really creative where you can set your payment schedules and, you can set it fixed. So where you receive everything a certain payment every month or every year, but you can also defer out the payments up to 40 years in certain situations. So you can really have them start exactly when you want to retire. If you're planning with your CPA, you can get really creative in how the payment streams come in so it fits with all your other financial pieces.
And then, yeah, you mentioned too on a buyer solution, right? This could be something where you can offer to the seller to alleviate their tax problem and in essence provide more net value from the offer.
Yeah, absolutely. I mean, if you're coming in, the most common solution is if a buyer, maybe, there's a property out there that's the seller has an unrealistic expectation of what they're gonna get for it. A buyer comes in at a little lower than asking price, but they say, hey, look what this solution, we're gonna alleviate your taxes, we're gonna spread it out over time, and over the course of 10 years, it's gonna be well above the asking price, plus you're an interest, plus all the great things we've been talking about. So the buyer gets it at a lower than asking. The seller gets all these wonderful things. Everybody wins.
Well, this is perfect. I'm glad you just mentioned that because we're going to go over an example of exactly what is this worth from a tax saving standpoint and growing money on money you would have otherwise paid to the government, right? So this money would have previously gone to the Fed or the state. And now in this case, we can actually invest it in something and make more money. And who doesn't want to make money off of money that would have went to taxes? All right. Case study, Mark and Cindy. So Mark and Cindy are retired. They own a home here in San Diego, fully paid off, and they'd like to sell the house to use the proceeds to fund their independent living community style. So John, walk us through this really on the nuts and bolts here of, great, what does this look like on paper?
Yeah, so I think this is a great walkthrough to kind of see the power of what this can do for you. So you can see the selling price is going to be $2 million. The basis started at the 500,000. That's what they bought it. And then we've included below that another 500,000 for the IRS exception for capital gains because they're married filing jointly. So when you add those together, the adjusted basis is $1 million. They're selling it for $2 million. So that leaves another $1 million of gross profit. And that's what's subject to the capital gains. And then if kind of look on the lower portion, you can see when you have $1 million of capital gains, you're going to hit all the government's bells and whistles. You're going to get maximum federal cap gains, maximum state cap gains. You're also going to hit the net investment tax, which is an additional 3.8% on the cap gains. So add that all up, your $2 million that you've sold, you have a $371,000 capital gains bill for that year if you do it all in a lump sum, which is a lot of money, obviously.
Yeah, that's a lot of money. Absolutely, that's worth something.
Yeah, and that's a big chunk out of what is Mark and Cindy's biggest asset. That just goes straight to the government. We'd like to present an option that is a little more favorable. So that leaves them with just over $1.6 million if they were going to use it towards their home or if they wanted to use it to invest in something else. And this slide just kind of breaks it down. We're giving a very basic example of a 10-year annuity where we're breaking up the payments. They're fixed monthly payments. We're showing it annually, but in this case, they were monthly payments. So essentially, when we're looking at this, you can see how the annuity pays and how you're subject to capital gains each year. So Year one, you get your principal back of $200,000 plus interest of $40,500, and then you're subject to $100,000 of capital gains in that year because it's 1/10 of the full million that's subject to cap gains. And that's kind of really where the power is here, because on the previous slide you saw with $1 million, you just, like I said, hit all the bells and whistles. Every maximum cap gains percentage you can hit, you're going to hit. And now we're starting at a much lower bracket in that year. We've got $100,000 capital gains. We can't tell you exactly what your percentage is going to be because we don't know what Mark and Cindy's other income is. Are they still working? Do they have other investments? Things like that. But you're starting at a much lower number to maybe bring that federal capital gains percentage from 20% to 15%. Maybe we can get the state of California from 13.3 down to 9%, something like that. And all of a sudden that adds up over time to where you're paying a lot less to Uncle Sam than you would otherwise. And along with that, you're earning interest on your investment that's steady and free from market volatility.
Right. So one of the things I just wanted to point out too is this is exactly why you're also working with your CPA, or your tax advisor, so they can help, I'm sure, layer this strategy of saying, cool, where could we receive X income such that it would get us in the most optimal tax bracket, or right, where is kind of that fine line, so we could try to play that strategy of really focusing on state, federal, and what amount we want to receive that we actually need for our living needs, right? The second thing I just wanted to point out is you're getting 200,000 principal, 100,000 capital gains. Why only 100,000? Well, because again, reminder, the other 100,000 is your basis and your exclusion, right? So only 100 of it. So the nice thing, what's happening here is you are getting more interest than you would have gotten off of a lower net proceed amount if you didn't do it. And then you would also have a higher capital gain amount as well. So you understanding the cumulative effect of saving money on taxes, making interest on that money, and structuring it in a very methodical way to really build more wealth as well. So a lot of different cash flow things going on here that aren't just tied to the interest rate that you get on this, right? There's a lot of factors involved. So great example, though. I think this is a good example of a very simple, straightforward, and know that this can be very sophisticated depending on your specific needs or situation.
Yeah, absolutely. We're going to get into some quotes later on, but yeah. And this slide just kind of, again, highlights what we're talking about here. If you take the $2 million sale, you put all of that $2 million into an annuity, as opposed to first getting hit with the capital gains tax and then having the leftover, which was about 1.6. Guaranteed payout of $2,405,000 over 10 years in equal monthly payments, and only $100,000 a year is subject to the capital gains. That's in the structured installment sale example. In the no structured installment sale example, your starting point is 1.629 million. And with a similar rate of return after 10 years, you're looking at 1.95 million essentially. So after 10 years of investing, you're still not even to where the starting point was on the structured installment sale. So hopefully that kind of shows the power of the compounding interest and starting at a higher number when you're putting those investments to use for you.
Yeah, I think, John, what we wanted to capture here on this slide was being able to show the impact over time, right? Not just, well, what's the difference on year one, but kind of more globally of what does it look like after 10 years? And that really helps hit home why you would consider doing this versus not.
Absolutely.
So product highlights, just at a glance here, John.
Sure. Yeah, we're going to run through some more examples, but one of the things I always like to point out, for certain people, you can defer the first payment up to 40 years. So that's, you make a sale in 2023 and you don't receive a payment until 2063. That is a possibility. That's obviously for a very unique situation, but you do have that option. There's very low investment minimum. So, we're talking about homes in the millions, but this can be lower numbers than that. There's no maximums. Design payments as needed. So again, you can get really creative where we've been showing examples with fixed monthly payments and fixed annual payments. If you want to do monthly payments with a large lump sum built in, maybe 5-10 years down the road, you want to add in a lump sum because there's going to be another investment opportunity and you want to have that liquidity, you can do that with these products. So you can get really creative, which is kind of fun. And then we've got we've got index linked market-based growth. So there are products that they won't be guaranteed payments. They're tied to an index, which we'll get into a little bit more, but it offers higher upside. Essentially, there's a little bit of risk involved, but you look at the historical data, there's some very good upside available to people that are interested in taking on a little bit more risk in the market. And then, as we've said a number of times, these are backed by highly rated, highly regulated life insurance companies so that you can feel safe that your money is being put to good work.
Perfect. And John, I wanted to mention, like in your example of maybe start putting a lump sum payment at a future date, like an example of that might be you're still in prime income earning years, right? And 10 years you're going to be retired, in which case your income is going to be much lower and you're going to have a lower tax bracket. So that would be an example where you want to really play into adding income or liquidity based on what your roadmap looks like with your current income and your intentions with retiring as well. So a lot of different things there. It really just shows you it's very specific to each client and what their specific needs are, which is great, right? It's not just a one size fits all. It really allows you to provide a very custom solution to your needs.
Yeah, absolutely.
Cool. Fixed growth versus index growth, right? So really, what is a fixed option versus a variable option, so to speak?
Yeah. So we talked about this a little bit. The case study we showed is a fixed growth option. So it's you have to start payments within 12 months of closing. So I mentioned deferring payments. In the fixed growth option, typically you got to the payments start very soon. They offer a smaller yield, usually between, I'm showing 2 and 3.75%. Really, right now where rates are, it's closer to the 3.75% than the 2, but it's based on the market. And the payments never change. So for those that just want steady Eddie, we know what our payments are going to be no matter what, it's a great option. The index linked growth, again, it offers greater flexibility, defer those payments up to 40 years. The returns are higher, usually in the 6 to 10% range. There's a guaranteed floor that says you'll always get your money back, even if Armageddon happens and the markets all go down for 10, 20 straight years. But it's tied to a specific index that has a lot of upside.
Okay. So let's go through we'll just fixed growth and variable growth so people can see on paper what this might look like.
Yeah, this is a traditional quote. You can see the carrier's MetLife. We're going to take a $250,000 sale, stretch it out over 20 years. We're going to get annual payments of $18,275. And over 20 years, that equals $365,500. So it's, again, steady Eddie. We know exactly what we're getting each year for 20 years, and here's what our benefits are going to be. Now, if we take that same example, and this is getting a little more creative, this is deferring payments. This is putting it into the indexed market option. You can see the index at kind of the middle part of the page is the Franklin B of A World Index, which essentially takes a lot of highly rated stocks in the United States, but also a lot of highly rated stocks overseas, mixes them together into an index. So it's got a great performance over the years. In this case, we're taking the same $250,000. We're going to do payments over 25 years. And instead of taking our first payment next year, we're going to take our first payment beginning in 2033. So we're pushing this out 10 years because we really want to maximize it. So again, this is not a solution for everybody. This is someone that doesn't need immediate liquidity. But you can see what the returns look like. You put $250,000 in, it gives you 3 columns: the historical lowest, historical medium, historical highest. We don't know what the payments are going to be because we don't know how the index is going to perform. But based on the data, in the historical lowest that this has ever been, you're going to get back about 6.6%. And over the course of that contract, your $250,000 turns into over 1.1 million. We go to the high side on that, which doesn't always happen, but it's based on the data. It can happen. You're looking at 11.2% growth, and you're turning that 250,000 into 3.4 million over the course of that 25 years. So can be very, very exciting.
Well, I was going to say, I mean, this a lot different than Steady Eddie on the prior slide. That if you elect to defer or have the ability to defer, there's a lot more fruits of your labor on the back end, right? We're looking at nearly 4 times the original investment, whereas on the past ones that were not deferred, they're lucky if they're double. So there certainly is some opportunity and upside to be had if you are willing and able to defer your payments, correct?
And you mentioned at the beginning, you're talking about generational wealth with a lot of your clients. A lot of your clients don't need the liquidity right now. They're thinking about their heirs and their heirs. If they can push this, they can use an asset to push this money out and grow it and make it into something wonderful for their kids and their grandkids. Here's an opportunity to do that.
Beautiful. We're trying not to give everyone a little bit of brain damage here. So just follow along. So John, maybe give us a lay of the land of what we're looking at here on this graph.
Yeah, I'll try and make this as simple as possible because there's a lot going on here. But this is basically just showing what the monthly payments would look like in this index-based product. The first column that's highlighted is in purple-ish. Is the 0% growth. So what this is saying is, okay, we're putting your money into this Franklin B of A index, which has performed very well for years and years and years. If it doesn't go up at all, or if it goes down every single year for 25 years, here are your guaranteed payments that you will receive. These are the monthly payments you'll get each year. So they go down over the course of 25 years, but you essentially get your money back if the markets all are destroyed, and I think we've got bigger problems if that happens. But that 250 you put in, you will get back. Then we get into the green columns, and again, we're talking about historically over the purpose of this index. The lowest portion of this is what your monthly payments would start at, and here's where they'd end. So if we're looking at the first year of payments, 2023 or 2033, excuse me. You'd start at monthly payments of $1,860, and then those just increase incrementally until you get down to year 23, and now you're getting $5,800 a month on those payments based on the index. And again, that's historically as low as it's ever been. You can look at the median if you want to be a little bit more conservative, and if you want to get frisky with it, you can look at the historical highest where you see those payments start at $2,800, and then by the time you get down to year 23, you're getting $27,000 a month in payments. So it's big numbers. And then the column on the right is compared to a fixed annuity. So the one we were talking about before, the Steady Eddie. This company, Independent Life, will offer you a fixed annuity if you want, and so you can just compare. Here's what the monthly payments will be if you want it guaranteed. And you see pretty quickly when you compare it to the historical lowest, those monthly payments overtake the index product, overtakes the fixed product pretty quickly. I think it's year 4 or 5, your payments start becoming a lot higher on the index product.
Yeah, I think one of the things I look at here is just say there seems to be a lot more upside on the variable than there is I guess safety on the 0% growth, right? Like the upside to be had on an incremental basis compared to the fixed or the sky is falling scenario is far greater. I mean, if you look at the payments, to your point, we can evidence that just looking at in year 2 and 3, we're already exceeding the fixed payment for all historical, median, and high. So you can be Steady Eddie or you can be Frisky Fred.
There you go. Yeah.
All right.
And
And then we wanted to give just another example of another growth example, right? So this would be another, if you did a variable.
well, this one's fixed, but it's just at a higher number. And then the next one, we'll show you the variable to really show the power of the numbers. This is a fixed option. If you were selling a $5 million property instead of 250,000, again, we're starting the payments in 2023. It's guaranteed for 20 years. The guaranteed benefits are going to be 7.26 million over those 20 years with a $5 million investment. And you see the IRR on that is 3.83%. So good return, nothing super flashy, but steady, you know what you're going to get. And then you take the indexed example. And again, this is deferred payments. So that's part of the reason that the growth is so high on this. We're not taking the payment right away. We're deferring it out. In this example, the first payment is in January of 2036. So we're deferring it out about 13 years. It's a 20-year payout from that date. And the numbers are pretty staggering. I mean, you put $5 million in, if you're able to defer that, the historical lowest, you're looking at a 6.4% rate of return. You're looking at $23 million. Median, just under 32 million, and the historical highest, $46 million. So big numbers, big upside in the market-based indexed option.
So let's talk about transactions that are not eligible, which I think most people on this call will be happy to know. Most of these will not apply to you, but John, maybe you can help us understand more about what some of these are exactly.
Yeah, I'll go through. I think the one at the bottom's the most pertinent, but I'll talk about all of them. So sales made by a dealer, that's if you're in the business of selling real estate. So if you're a home builder, if you're a developer, you can't use the installment method of accounting because you're taxed differently. Essentially, I'm not going to go into it too much, but sale of inventory related to a personal property. So if you're selling inventory of a business, you're not able to do it this way. A depreciable property to a related person. So if you've got a property that you've depreciated and you sell it to a spouse or a child or something like that, that's not going to be eligible. Personal property, again, I don't think that's not going to apply here. Publicly traded property. But then the last one is gain attributed to depreciation recapture. I'm sure a lot of your clients have depreciable properties out there. So that portion, and if we went all the way back to the case study, there is a line item on our kind of workbook that shows the depreciation recapture, because the depreciation recapture has to be paid in the year of the sale. So that is not something that you can defer out. That's paid as ordinary income in the year of the sale. So that is, for certain clients, I'll let you speak to this a little bit, Nick, that may, you can turn that into or defer that out with a 1031 is my understanding. So for certain clients, again, this might not be the best solution.
Yeah, John, I'm glad you covered this one, because this is one I came across and I kind of stopped and said, well, okay. So really what it's saying is, first of all, it's for the primary residence or a second home, there is no depreciation, right? You can't depreciate an owner-occupied residence or second home. So therefore, this would not be a bad thing because it would not apply to you. However, if it is an investment property, well, that is obviously more significant, as a lot of people are looking to defer taxes, and the depreciation recapture is one of those, right? Because depreciation recapture is a 25% tax. So this is to say, this tool and product really provides more value from a owner-occupied standpoint, from a tax mitigation. However, there are some instances where even with the depreciation recapture being paid, this could still be a vehicle for you in the form of diversification or really just simplification, right? We have a lot of clients that own a lot of assets, and what's most important to them at this point is not profits or doors, it's how do I make my life more simple so that I can enjoy this time that I earned from all my hard work. And so this is another way they can do that. So for the most part, a lot of these are not applicable to you, but Biggest thing, depreciation recapture, right? That's the big takeaway from this.
There you go.
And then John, documents required. And I think also too, mentioning how does this impact the timeline, or how long does this process take? So what's needed to get it started, and how long does it take?
Yeah, so because there's a life insurance company involved, there's a number of forms that they're going to want to fill out. I like to, if you're thinking about doing this, I like to get everyone at the table 2 to 3 weeks prior to closing. If you want to be really conservative, 4 weeks before closing. The reason for that is because, as you can see on some of these forms, the buyer is going to have to sign off on this, and they're going to have to fill out some forms. The seller is going to have to fill out some forms. So, I mean, it can be done in a week. It can be done in a couple of days, but I think you don't want to rush something like this. It's a big time transaction, so you want to make sure everybody is comfortable with it. But the reason we put this slide in there is just to let people know this is an extra step, because you're involving the life insurance company. The buyer's got to sign off on it. You want to make sure everyone is understanding what's happening early in the process, so that you think you're going to do this, and then you present it to the buyer and they scoff at it because they've never heard of it or whatever reason. And I think you mentioned this, Nick, early on. It's also good to get your CPA or a CPA involved earlier in the process as well, because you want to make sure that the people that are advising you as the seller are totally comfortable with this, because they're going to be the ones making sure that those taxes that we're avoiding are filed the right way. So overall message, bring everyone to the table early. Let's start talking early. Don't wait till the last minute.
Yeah, and to second on that, I would just say, if you're considering this, really, it's call me. I'll give you an opinion of value. Talk to John, and then at least you can start to get an understanding of what does this look like, right? And kind of what I can expect, so that you're not trying to accomplish this research and execution already within an escrow period. So if you want to just understand more about what it would look like with your situation, that's something we can do that doesn't require you to open an escrow. So just know, the more information, education you get up front, especially before you move forward in a transaction, the better outcome for everyone. And that's something we're always going to harp on. So, John, thank you very much for your commitment of time to educate the Emerson Group community. We trust that everyone has got some good ahas and nuggets out of this information. And if anyone has any questions or want to go over a specific scenario to them, here's John's information. Reach out to him directly. John, anything else that you'd like to say?
No. Again, I just want to thank everybody for having me on. I'm looking forward to hopefully working with your clients. And if you want to talk to Nick before you talk to me, feel free. We're very collaborative, so we want to make sure everybody has as much information as possible.
Awesome. Thanks again, John. We appreciate your time. And lastly, before we go, just quick reminders of how the Emerson Group can help. We can provide you a free asset performance test. So understand what your net operating income is for your asset and what the performance is relative to other assets in the area or in the open market. Free rental property analysis, where we can see what your current rents are, compare them to the market, and whether you're performing under, over, or right at market. And then lastly, if you want to access our past calls or get an idea of what our future upcoming calls might be, feel free to access our YouTube channel here. Outside of that, we look forward to seeing you next month on our next wealth call, and have a wealthy weekend ahead.